Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. So we're live now. Again, this is my second one today. Excited to get another guest on here. After my discussion with Itamar, who's our guest today, Itamar Novick from Recursive Ventures, it's just really exciting to kind of hear more about the ecosystem on the West Coast, especially Silicon Valley, with me being a New Yorker. So Itamar is an emerging manager, also a really seasoned entrepreneur. I think you had an exit a couple of years ago, right?
Yeah, that's true. I was fortunate to be part of the Life 360 journey and help take it public in 2019.
Yeah. So excited to kind of go deep in terms of that entire journey. And there's a lot of people that, as a pathway to venture capital, that's kind of been their jump off point, right? They were an operator, successfully took a company to liquidity, probably did not want to start another company or just kind of got excited about maybe building a firm. And I think the benefit of launching a firm is being able to support many companies at scale, right? Because I mean, your entire time and energy really goes into really building one company and really taking that to where it needs to be. And it's tough to do multiple things at the same time. So I think you get a little bit of leverage running a firm and investing, opposed to, focusing on one company. But we're going to talk about all that. But again, thank you again for being a guest. Excited to hear about your journey. So if we were to just kick this off, maybe you can share a little bit about your family, your background, where you grew up. And let's start with how you started your company, your first company.
Yeah. So thanks for having me, Joel. I'm really excited to be here on this podcast, and thanks for everybody that's listening. I've been in startups my entire professional career, which is roughly 20 years now. And I started off. I'm originally from Israel, so I was in the Israeli Defense Force, which is mandatory. You got to go serve your country for 3 years. And I've been coding my entire life. I think I started coding when I was 11 or 12. So I had like decent coding skills, engineering skills, and I also leveraged some of that in my service in the IDF. So when I left the Army, it was actually 2000, 2001, that period, sort of the end of the bubble.
So you served for 3 years.
Yes.
Yeah.
And I guess back then in Israel, we just didn't get the memo that the bubble has burst in the US, right? We didn't get the memo. And I was like, oh my God, so what if I'm 21, I'm going to open this startup company and it's going to be massive. And I'm going to IPO it for billions of dollars. So I just need to get going. And that's really what I did when I left the service. I started a software company focused on billing, which was, an interesting area back then. Still is today in many ways. And, I had one customer. It was the Israeli government. And I thought this is going to be this massive startup. And then a year in, my single customer, which is the Israeli government, calls me and tells me, hey, nobody's really using your software. We're still using pen and paper to get the billing calculations going. And I was like, no, but we did training and everybody should be up to speed on what you're supposed to do. And they're like, no, not really. Can we just stop paying you the license for the software? I was like, oh my God, the sky is falling. I have to part ways with the 7 employees that I hired, and basically realized that I don't know a lot about business and I should learn from some of the best. So my first startup story was, a complete failure. But guess what? It's a learning opportunity.
Yeah. It's also your mentality of how you see life too, right? So I think there's some people that think your failures really define who you are. And a lot of us have different times in our life. I feel like there's different seasons, right? So there's a great season where you're crushing it and like you're the hero. And then there's other times in life where you're at a low time. And some people feel like that defines us, right? Or like if you're super smart, I mean, I worked in corporate America, right? So if you're super smart and then you got laid off, it's a huge maybe tarnish in your mind. It's like, oh, I'm a failure. Like I'm not smart enough for like working for these sophisticated corporates. So that's who I am. I'm defined by my job, but I feel personally like we're all these beings, and we can literally kind of take our journey however we want to take it. And I've seen people completely turn things around, kind of like how you did. But any reactions to what I just said, or just kind of like that
Yeah,
mindset?
I again, I embrace failure, and I encourage
Yeah.
my founders to embrace failure as well. Failing
Hmm.
fast, as we all know, is sometimes a very positive thing to do, and
Yeah.
continuing to harp on something that doesn't work or doesn't scale and kind of wasting your time. I mean, time is money, so
Yeah.
I don't view failure as something negative. And also, in reaction to what you said, if I was working in corporate America and somebody basically canceled my entire department, and it's not really personal, and I get laid off in the process, I
Yeah.
wouldn't feel myself, I wouldn't think that it's a failure. It's
Hmm.
just, sometimes people high up make
Yeah.
decisions because they've got to make those decisions, and it's not really, it doesn't really, reflect on my capabilities and my contribution to the organization.
Hmm. Yeah.
Happens all the
Yeah. And
time.
I mean, it's, one may say it's just as risky to join a company than start your own, because at least you can't fire yourself, hypothetically. I mean, in theory, you can't, but, at least you can kind of have some control of your destiny, even if you have to kind of uh, reorganize your company where you're at the mercy of the organization, right? If you're working for somebody. So,
Well, it's true, but if you look at the classic startup journey, it's actually a journey where you start with all the control, and
hmm,
then over time you
give away
lose that
control.
control to build something bigger, right?
Yeah.
And I mean, we can have a whole podcast just about that, but that creates a lot of friction sometimes,
Yeah.
where it used to be your baby as a founder, and suddenly it's everybody else's baby, and then you even go public, and then it's really everybody's
Yeah.
baby, and you got to adjust, and you got to change as a founder. So
Hmm.
the perception of, it's my company, I'm in control, doesn't really
Hmm.
last all the way through, and you have to
Yeah.
readjust as a founder. But that's, it's for all the good reasons, all the right reasons when you do it.
Yeah, and I think it's, a framework too is control versus freedom, right? So if you have full control, a lot of times you don't have freedom because you have to control everything, you have to manage everything, and then if you can give away some freedom, you are giving away control. Maybe even having somebody operate the entire company, and maybe you're a chairperson. But so tell me about the next chapter. So the company didn't work out. You lost your sole client. So what did you do? You just dissolved the company and just thought about the next
Yeah,
step.
dissolved the company and figured
Hmm.
out that I should go and work for people that know more than me, that are smarter than me, that are more experienced. I
Hmm.
started working in the Israeli tech scene in a bunch of startups, and I was very fortunate to come across the founders of a company called Gigya,
Hmm.
and that was 2007-ish time frame. And they were just amazing, brilliant founders. I've learned so much from them, and this is an advice I give young professionals who are focused on startups and want to be creating their own startups in the future, or really building a career in the startup ecosystem. Typically, the advice that I give folks is, look, just find the smartest repeat entrepreneur that and whatever they want you to do in the company, whatever title you would take on if you would join the company, just do it. Because really, the
Hmm.
opportunity, it's an apprenticeship business. The opportunity to learn from the best entrepreneurs
Hmm.
is the best opportunity you can have to kind of educate yourself on how to build companies down the line. And I was very fortunate that coming into Gigia, I was the employee number 5, the first product manager, and the founding team. The founders were just stellar. They knew everything about the web. Web was the big thing back then. They were cutting edge from a technology standpoint, from a business standpoint. I mean, they built a SaaS company in 2006, 2007. Like, nobody was even
Hmm.
thinking about SaaS, and it was a developer platform with APIs, charging for API usage. This is 2006, 2007. Like, it's way ahead of the curve.
Sure.
Right? So I was fortunate to learn from some of those folks, and the company ended up selling to SAP for $350 million. It was a Mayfield benchmark first round back company. So,
Hmm.
very, very good VCs, very good founders involved, and at the end, a great exit. And that was sort of my first real experience, sort of seeing the light of, oh, wow, like
Hmm.
startups, it could work. If you do it right, it could work
Yeah.
for everybody's benefit.
And I think a good tip, Gary Tan put out an episode for students, one of his YouTube shows, where he talked about learning while you earn. So I think that's a great way. If you can just work for an operator, you can learn while you're doing all that operational work, and then also get paid. It's kind of a win-win.
It's a win-win. And again, I would really focus on who would be the best mentor to teach me startups, because it's sort of a profession, right? Like some people have a natural knack for it and they just like build their first company and they get it and they know what to do and it works out. But the majority of people, that's not the case. The majority of people that know how to make startups scale and really tick, they have had previous experiences, either as repeat founders, it's their second or third rodeo, or they've learned from really good entrepreneurs and they kind of know how to navigate through building a company at the earliest stages.
Sure. And so you worked at a company, operated a company all the way out to the IPO.
Well, it wasn't an IPO. They sold the company eventually to SAP for $20 million, and I was I was spending time on the kind of link between Silicon Valley and Silicon Wadi, Israel, right? Tel Aviv, which has the biggest number of startups, I think, outside of Silicon Valley. Thousands and thousands of startups, huge startup ecosystem back in Israel, right? And because we also at Giga, we had an office in Palo Alto, I was spending increasingly more and more time in the Valley. And I, being back then, I think it still is, different conversation, being the Mecca for startups, I figured that I might as well, move over. And I moved to the States in 2010 to get my MBA at Berkeley Haas, with a mindset of, oh wow, I really want to learn from the best. Maybe I should, try to do venture capital. And I was very fortunate. I came for school. I was very fortunate that within a few months, I joined Morgan Ventures, which was a great Sand Hill Road VC, and kind of learned, the VC, ropes from some of the best in the business. Back then, I was a junior guy, a senior associate, at Morgan Ventures, and it was a great time. I think about like 2009, 2010, 2011. Those are some of the best vintages in venture capital, right? So I think
2009 to 2011.
Yeah. Some of the best vintages in venture capital. And I think, the time, what we had then is actually what I think would unfold in 2023, 2024, 2025, different conversation. But I was fortunate to be part of the ride from a VC point of view in the beginning of mobile. Right, so Morgan was an investor in Evernote, which back then was really like the number one productivity, business productivity play in mobile.
That was huge, yeah.
And Morgan Ventures was also an early investor in Lending Club, which I now consider part of the second wave of fintech innovation, and the key wave that's still ongoing in many ways in fintech, which is kind of business model innovation, right? Like trying to rethink how we do finance. So that gave me sort of a front seat view into all the disruption that's happening in the world and still happening today. And through that, I was fortunate to also meet Life 360, which was brought in for us to invest in the seed. I did all diligence. We didn't end up investing, but I ended up staying close to the company, supporting them as an advisor. And later on, I decided that I should, basically, I realized that there is no clear career path from being a senior associate at a venture fund to being a general partner. And the right thing to do for me was to go in, hands-on, help build another big company, right? A significant company, and then potentially, go back to venture capital. So now basically I'm, full circle, having went through the Life 360 journey and back into venture capital.
Sure. So what was your role at Life 360? And maybe you can talk a little more about the company and maybe some of the inflection points that you experienced working there and and scaling it to an exit?
Well, so I actually did something a little bit untraditional.
Mm-hmm.
And when I came into Life 360, I really doubled down on the company because I bought a co-founder that wanted to leave. So
Mm-hmm.
I basically joined the company after its formation, but joined it as, let's call it, a late co-founder, because I had a
Mm-hmm.
co-founder position, right?
Okay.
Um,
Yeah.
Initially, I was running product. After that, I was sort of doing a bunch of CO type of stuff. So I started taking on operations, customer support, design, finance. And
Mm-hmm.
then over time, I gravitated, as the company scaled, I gravitated more toward finance, legal, and business development, corporate development. So basically had kind of every role in the company other than CTO and CEO, which, my
Mm-hmm.
two partners were running those. Um, and it was, for me, it was a 10-year journey. It was a crazy journey. The company almost died twice. Honestly, it was pretty hectic.
Yeah.
We weren't real well understood. It was funny because on one end, it's a Silicon Valley company, and it's been so disruptive in its area and has done so well. But on the other hand, we weren't really fully recognized by Silicon
Mm-hmm.
Valley. Like every VC firm on Sand Hill basically passed on the deal, right? And
Sure.
early on.
Why
Um,
do you think they passed? Was it just like product market fit, or just the business model, or they just weren't interested?
I think they didn't understand Life 360. And
Yeah.
I think many people don't understand Life 360 even today. So I'll give a little bit of background.
Yeah.
So the way I view Life 360 is we're basically the family network, like a safety and peace of mind product for families, for parents,
Mm-hmm.
and for teens, right?
Yeah.
So the the first functionality, which is free and will always remain free, it's a freemium app, is it gives you the ability to see people's location in real time, right?
Mm-hmm.
So
Can
it's
you
really,
integrate it in with the Apple tag? Because that would be nice to put a little tag in my little son's book bag, just in case, I don't know where he is. At least I can kind of, have some tracking of where he is, because he doesn't have a phone right now.
so actually Life 360 acquired Tile, which
Oh,
was,
got it. Okay.
so
Yeah.
Tile is part of Life 360, and
Okay.
today Life 360 enables you to see, track, whatever you want to call it, people, pets,
Mm-hmm.
and things, right?
Sure.
So there's tags there
Mm-hmm.
for things and people, and then there's also the smartphone itself. If your kid has a smartphone, then you can see where
Mm-hmm.
they're at. Where they're supposed to be in that right neighborhood, where in their friend's house, and kind of know that they're safe. And I think what a lot of VCs missed here is that there is demand for this product. Like
Mm-hmm.
parents and teens, they want this product because it
Yeah.
creates this contract that helps everybody feel a little bit safer, that things are under control, and it creates that peace of mind. So there's real demand for the product. And that's also what I saw when I was doing diligence as a senior associate on the company. I was like, wow, at the top of the funnel for this company, there is
Mm-hmm.
massive demand. Like people want this thing, right? So that's really the basics. Then on top of that, what we built is really a robust, freemium safety and peace of mind product for families. Think about it,
Mm-hmm.
it's a membership. Think about it like Amazon Prime, but for families that want to have a little bit of peace of mind day to
Mm-hmm.
day. So we added features like crash detection and response, which is a life-saving feature, right? Basically, using your smartphone and using the accelerometer, the gyro, even Bluetooth, we know that you've been going 50 miles per hour, got hit by the side at 20 miles per hour, and got dragged for 50 yards, and that this is a severity 8 accident. And we can really, at the time we see that accident, we know in real time, we know the location, and we can have an ambulance get to you faster.
Mm-hmm.
And Life 360 sends dozens of ambulances daily now in the US.
Wow.
The company has 15 million monthly active users, one of the biggest apps in the world.
Wow. When do you think humans will be comfortable with implanting a chip? Maybe right here or something. Like right here doesn't hurt that much. It's like an earring, right? But like implanting something to kind of just track people better. Do you think we'll ever be comfortable doing that?
I think we will.
Yeah.
It's
I mean, if
it's
it's like on a piece of extra skin or something, I mean, I'd probably put it on my kid.
If the benefits are going to be so crazy,
Yeah,
going to be
it's really
so
for safety, for tracking, so you know where everybody is.
But that I'm not sure tracking by itself is a big enough benefit that would
Yeah.
justify that intrusive device. But if I give you a device, let's say it's an implant in your brain that would help you instantly recall or instantly access any type of data,
Mm-hmm.
I think the benefits would be so huge that they would outweigh any potential concerns
Yeah.
around, having an implant. So it's really for me an equation of benefits versus
Yeah.
downside. When the benefits outweigh the downside, then
I think
people.
the accelerometer, so especially with elderly people, if there's a fall, a lot of times there's no knowledge. You know where they are, to your point, right? But you don't know if they actually fell. So if there's some type of tracking or some type of motion detection, which is like and not a typical way that they've moved really, and it kind of relates to a fall. At least it kind of gets you to be aware of that, so you can just maybe triple check to make sure they're okay. And if they're not picking up the phone, and it's been an hour, then at least you can do something about it versus not knowing about
Absolutely, and Life 360 is a player in senior care as well, and there's a
it. Hmm.
lot of opportunities in that space. I don't know if you've been following the senior care space, but I think it's one of the
Hmm.
spaces that has been least disrupted by technology so far.
Yeah,
So, and
and
definitely
it's
an
the
area.
biggest market size. Everybody in the entire world is going to be old, right? So there's always some type of need for it. It's not going to become obsolete like elderly care. As long as there's humans on the earth and the population is growing, it's a growing, in my mind, a growing market size.
Correct.
Yeah.
So with Life 360, I think the bottom line is it wasn't well understood early on. People thought
Hmm.
about it as a tracker. They didn't understand that actually what we're building is the leading family brand and safety and peace of mind product.
Hmm.
And I think now folks understand that. The company has gone public. It has, I mean, all the data is out there. Hundreds of millions of dollars in revenue, 50 million monthly active users, and over 1.5 million families paying for the paid products, which include a bundle of several things, not just the crash
Hmm.
detection and response. There's also identity theft there, and medical assistance, and a bunch of other products that really help, parents have more peace of mind when it comes to the safety of their family.
Yeah. And then what were some of your biggest learnings working there? I know you literally took that ride for 10 years. You told me the company, almost went under. That's pretty typical for every single business. There's that time that happens. But what are your biggest takeaways in maybe life and also in business, just looking back, if you were to summarize?
Yeah, I mean, well, there's a lot. What would be the highlights? I guess what brought us here is not necessarily what's going to bring us to the next level.
Hmm.
Um, that's. I mean, people say that, but a lot. But it's kind of when you see it firsthand, you understand it in depth. Like I think startups in their journey to scale up, then they tend to break culturally, right?
Hmm.
And their mode of operation, the way they operate, tends to change rapidly at certain points,
Hmm.
right? The first point that I typically see startups kind of break in is somewhere between 15, 25, 30 employees. And that's when you get to a point where there's not just like the founders who are running the company and a bunch of
Hmm.
employees working with them. Suddenly you introduce management to the company, and there's layers, right? There's at least one layer of
Yeah.
management under the founders. And whenever that happens, the whole communication structure breaks. And you have
Hmm.
this need to start really reinforcing, values and culture. And here's how we do things in this company, right? So
Hmm.
that's kind of the first point where leadership needs to change and adopt, right? Then typically there's another breaking point. It's like
So
15 to
what's the purpose of the management? So there's the maybe for the audience, you can maybe just give, you don't have to give a specific example, but like a typical example when they get to scale. What round is that? Is that like growth equity round where they get to that stage, or so there's the co-founders. They probably hired a team of engineers below them, probably some product developers, right? So it's kind of still a core team. And then what stage do they need to come in and hire like like a chief customer officer or something like that. I guess what's that? What are those titles of those people? And then kind of how
Well,
does that change?
I think it really depends on the business, and B, it
Yeah.
really depends on the founder's DNA and what they're good
Mhm.
at, right? If as a founder you're really good at one thing, let's say engineering, but you're not great at hand holding customers through to
Mhm.
success, then you might want to hire a chief customer success officer early. I don't know. It
Yeah.
really depends on your situation,
Mhm.
but typically, senior management is brought in when you have product market fit, when you're
Mhm.
ready to start scaling, right?
Yeah.
I don't expect, as an investor, I
Mhm.
don't expect founders to kind of, parachute in senior executives to figure out what the product should be and where the product market fit is.
Yeah.
That's typically the founder's job and the
Mhm.
founding team, early employees' job. And once you have it, once you know what you're selling, who exactly is the buyer persona, and how to best serve them, then
Mhm.
potentially you're ready to scale up, and that's when you need to increasingly add more and more and more executives who have experience in scaling up organizations.
Yeah. So I would say, in my opinion, I'm assuming definitely after Series A, but probably around the late Series A, Series B is kind of when they really are ready for, more of the senior executive management. I don't know if that's kind of what you're thinking too.
Well, I really think about a company's evolution in terms of product market fit
Yeah.
versus a series of investment they're in, right? Because
Mhm.
I mean, we have people starting companies, especially we had them during this recent bubble that burst last year. That's at least my view that we're
Mhm.
in a bubble and it burst. We've had people raise $50 million out of the bat, which is an equivalent to a Series A. Do they have product market fit? I doubt that.
Yeah.
That takes time. And the way I think about it, even like taking it more to a philosophical level, is startups, entrepreneurship, being a founder is basically a journey. It's a journey
Mhm.
inside the founder's head of how quickly they get from where they are today to a place where they really understand their product market fit. Like, what are
Yeah.
we selling? What are we doing? How are we positioning this thing? The faster you kind of sprint through that and the
Mhm.
different stages of like getting to that realization of what is this thing, the better off you would do, right? It's
Yeah.
the journey in the founder's
Sure.
head. And
And let me rephrase my question too. So, what is your definition of product market fit, and how do you measure that? Is it a revenue metric? Is it staffing metric? I guess what is product market fit, in your
product market
opinion?
fit is when you know you can repeatedly
Mm-hmm.
provide the same value proposition to a set of customers. You can do it in
Mm-hmm.
a scalable way,
Yeah.
and there is a high likelihood that they would be interested in buying and paying and have a high willingness to pay,
Yeah.
uh, that drives decent unit economics. And that's really, and of course there's nuances like, do you know
Sure.
how to do the go to market for that?
Yeah.
Yes, that's an important part of product market fit.
Mm-hmm.
Is your product actually built and delivering all those things that you promised? Of course, that's also
Mm-hmm.
important. But really, that those are the basic building blocks. Do you have something, a product that you can sit in front of the same type of target customer in different companies, in
Mm-hmm.
different verticals,
Yep.
and they're going to look at this and they're going to say, "Wow, I really want to consider buying this thing." That's product market fit. Not just
Yeah.
once, but again
Mm-hmm.
and again and again.
Yeah. Yeah, no, that's a good analogy, and I think also it's interesting. I mean, I also see it as if you can essentially predictably turn up the dial. So, like, if you wanted to, like, if you're at like 100K or 150K in revenue, if you wanted to, you could probably turn up the dial to get to like 300, 400K in revenue, but you still have to kind of like do that slowly, or else things are going to go crazy. You have to kind of have the infrastructure and the customer support in place. But as far as maybe acquiring those customers, you probably could if you just turn the dial in a very repeatable way. And then it's very easy for the VCs as they're evaluating the companies to maybe see that as well. And then I also think it's really interesting with just B2B SaaS. If you're building the product one time, essentially it's a beautiful thing if you can build it once and then sell it 100 times,
Right.
the same
I,
exact
I I
product.
wish it was that easy, but I think one thing that a lot of founders don't always think through is this
Hmm.
concept of really like unit economics, and why are software companies so valuable? People don't
Hmm.
always think about that. The reason why software companies can get to be so valuable is because the marginal cost of servicing one more customer trends to zero. That's really the power of software. You build
Yeah.
it once. Of course, this is very theoretical because you have to keep updating and really making your software better. But conceptually, you build the software once and you can replicate it and give it to 1,000 customers, right?
Yeah.
And that's why software companies are so highly valued, because
Mhm.
their terminal margins could be amazing, right? Unlike traditional businesses where you spend a lot of money in cost of goods sold or other,
Mhm.
types of services, types of businesses. That's really the magic of software, and why, software companies are the most valuable companies in the world right now.
Yeah. No, that's totally true. Totally agree with you. I think it's really the concept of leverage, right? So having a few inputs for many in exchange for many outputs versus, a lot of these physical businesses, there's a lot of labor and time and inputs for maybe a minimal amount of, outputs, right? Maybe 1 or 2x outputs. So I think the software platforms and approaches definitely get you there. So you took this company all the way out to the IPO, and maybe for the audience, you can walk people through what happens typically when a company goes through an IPO. And some of the people here are interested in learning about transitioning into VC. But typically, in my experience, if you're part of the founding team or even if you're the CEO, you still have to kind of be part of the larger conglomerate as an employee for like 3-4 years and vest out. So maybe you can share a couple examples of like how those play out, the pros and cons of getting acquired by a big company versus just getting bought out. And then sometimes you get bought out in cash, sometimes you get bought out in shares. So any just high level thoughts in terms of just exits and how founders should think about that.
Yeah. So let's start with IPOs, because that's
Hmm.
one area that I clearly am knowledgeable about. I was actually running our IPO process at Life 360. So an
Hmm.
IPO is not an exit, quote unquote. It
Yeah.
is really a milestone in the company's
Mhm.
evolution of
Yeah.
becoming public and living up to being a public company in terms of standards, right? And what
Hmm.
and setting expectations with the public markets. It is a milestone. It is not a liquidity event,
Hmm.
and it's a continuation of a journey. So, and a lot of folks might think that going public is magical and money rains from the sky. No, it is one more step in making your company bigger and more valuable and
Hmm.
more impactful. Um, Unlike IPOs, selling your company to a bigger company is, you get liquidity fairly quickly. If it's a cash, buyout, then you get cash instantly for the value of the company. And if it's with stock or all stock, part stock, then you can hopefully liquidate in a fairly short amount of time, right?
Hmm.
Um, so I think really, actually, this is true for any investment slash funding opportunity or round that you're putting
Hmm.
together. At any point in time, as a founder, you should look at all the options on the table. I can raise money, which means selling a piece of my company for this much, right? I'm gonna get cash in and I'm gonna give away 10-20% of my company, right?
Hmm.
That's a funding decision. Or I can sell my company and get out of the business now, get cash as a founder, and here it is. You really realize the value of your investment so far, right? And cashed out. And of course, there's other options. So in every one of those intersections, what I encourage the founders to do is really think about what they want to do and where they can maximize value for
Hmm.
all the stakeholders in the company. Does it make sense to sell now because that is a local maximum and you're going to maximize the value creation for your shareholders, for you as founders, and for your employees and customers? Okay, that might be the right decision. Do you think that there's a long way to go here and we're just getting started and you should take a funding round in, take the 10-20 million that VCs are offering you, give them this share of the company, and then take that money and invest it in the business in order to create an even greater return for all the stakeholders? great, then that's the right choice. And every time you get into this funding / acquisition situation, you gotta think through that equation of like, what is the path that maximizes value for all the stakeholders in the company? And
Mm-hmm.
you got to be thoughtful about it, because it impacts not just you as a founder, it impacts everybody around the table. Like,
Yeah.
everybody is relying on the company to make the right decisions there.
Mm-hmm.
So it is an important intersection in the company's life that you have to really think through.
Yeah. No, that's really helpful. And as you're building this track record of kind of like being a founder, people that do come into liquidity, what have you seen in terms of like their next step, and how do they what's their outtake on life? I mean, I've seen a lot of people that come into liquidity, they kind of don't know what to do, so that's kind of the impetus for Tiger 21. And they have like, why, I guess Tiger 21 is probably more relevant than YPO is for CEOs. But there's people that they just sold their company, and they just kind of maybe fall into some type of weird funk because they're not doing anything anymore, right? So you being in Silicon Valley, I'm sure you've ran into a lot of people that have been in that situation. So what's the mindset that somebody should have when they come into liquidity? Obviously, talk to an accountant first to make sure that you deal with all the income tax and all that. But that's what I would do first, probably. But
Right.
any reactions to just kind of like,
So
or
look,
just observations to your peers that have kind of come into liquidity, and how they think about wealth and like what's supposed to be done next?
so I'd say the cases you're describing are the exception in
Yeah.
my world, at least. Like, most
Mm-hmm.
people that come into significant liquidity, those are the type of people that are not going to stop, right? And
Yeah.
it's the same mentality of like building a company to really make it great
Yeah.
versus building a company to sell it to somebody in the short
Mm-hmm.
term. If
Yeah.
you do the latter, you're not going to sell the company, because only when you try to build something really, really big and you're thinking about it long term would somebody step in somewhere in the process and say, wow, I want to take this from here forward to building a huge company with you, and that's why
Mm-hmm.
I'm going to buy it. You don't
Yeah.
get to exit by dumping assets at people. That
Mm-hmm.
doesn't really produce, for in most cases, the kind of
Well,
result.
yeah, I mean, I'm thinking about like, maybe an example you're talking about is like Travis Kalanick, right? He sold Red Swoosh. He probably took, he came into liquidity, I think, and then he came in, and then he, and then he launched. I think Uber was right after Red Swoosh, right?
Mhm.
But it's people like him. They keep building, right? I mean, after
Keep
Uber,
building, right.
he's got Cloud Kitchen. So that's kind of
So I
how
think
I
most
think
people
about
that I
stuff.
see are that way. Like, they keep
Hmm.
building, they go on to the next thing.
Yeah.
It could be another company. It could
Hmm.
be working with other companies like VCs. It could be a lot of things, but
Yeah.
most people don't just retire on some tropical island and
Yeah.
kind of,
Hmm.
I mean, the majority.
Well, I
Uh,
think the whole purpose of Tiger 21, from, I just watched the video with the founder. So I think sometimes it's just good to have maybe a support system or a community of other people that have gone through the same thing, to kind of think about, to help you maybe think about the next thing. Like, hey, should I launch another company? Do I have another one in me? Or should I launch a fund? And,
right.
maybe that's my next question for you. Why not build another life? Why not build another Life 360 type of company, or join another operating team? What made you decide to join a fund? I mean, start a fund.
Actually start a fund or
Yeah.
continue, because Recursive
Yeah.
Ventures has actually been around for 10 years now. I've been
Okay.
moonlighting, and I've
Yeah.
had Recursive Ventures 1 and Recursive
And you
Ventures
built that
2.
track record over time as well. Yeah.
Yes, but
Mhm.
now I'm really focused on Recursive Ventures 3, which is
Yeah.
a full scale kind of full
Hmm.
time gig for me. So
Yeah.
I'd say, here's the non obvious question, non obvious answer. I
Yeah.
think VC is actually not for everybody. A lot of
Hmm.
people that come into VC, they're kind of disappointed because it looks
Yeah.
so glorious and great on the other side. Everybody's rushing to you, they get funded, and it's just like you feel like you're at the top of the world. Actually, VC is 90+% kind of negative in
Hmm.
many ways. I mean, you say no to founders 99% of the time, otherwise
Yeah.
you're not really doing your job. Most companies fail, so there's actually it's pretty tough, and there's a lot of negativity involved. But I'd
Yeah.
say, just more generally, being a VC is something that, like, becoming a VC is something that probably takes 5 to 10 years of training to do. And
Yeah,
for me specifically, I was a VC before I went into Life 360. Kind of
you
spent
did.
2 years doing that. I also built an incubator called Upwest Labs
Hmm.
at the same time frame. So I spent a bunch of years getting basic training in venture capital and really experiencing venture capital. Then went back to building a company, and now I'm
Hmm.
back to being a VC. So I
Yeah.
kind of know what I'm getting into.
Hmm.
And I think there are a lot of people now in the category in venture capital with they don't necessarily know what they're getting into, and they haven't necessarily been trained. And it's okay, that's why
Hmm.
we have a lot of emerging managers, and the diversity is extremely important for us to being able to create innovative and disruptive companies.
Yeah.
But at the same time, I don't think it's for everybody. And I think
Hmm.
it's because either they're not going to be happy at the job. It's a different job. You're not
Yeah.
building stuff. You're really there to support founders, right? You're really on the financing side. It's different. You're not going to have the experience of building something and seeing it
Hmm.
grow, right? So that's kind of disappointing for some folks. That's one. The other thing that, I've already mentioned is there's a lot of negativity in venture capital. Like, probably one of the most important skills is being great at saying no.
Yeah.
That's not fun.
I know.
um, and then people don't necessarily expect that. And the last thing, especially in this environment, is people don't necessarily appreciate how hard it is to be a VC.
Hmm.
It, I actually work harder as a VC than I worked as an entrepreneur, because
What
a lot.
makes it harder than being an entrepreneur?
I think as an entrepreneur, you you do a bunch of sales all the time when you're selling your
Hmm.
company, you're selling it, you're selling to customers. But I think as a VC, you're constantly selling because in a way you're almost always fundraising, especially as an emerging manager. Like, an emerging manager raises money. It's like a big chunk of their job
Yeah.
for like the first 5 to 10 years.
Yeah. And they don't have all these huge, LP demo days, right? I mean, they have small private groups that you have to get invited to. You sent me a private link to some event that nobody knew about, only because you and I chatted. Like, I was lucky to get that secret invite. Versus, like, VCs are everywhere. You go to the startup demo day, you go to Techstars, there's a bunch of VCs. They have like emerging manager happy hours where, like, you don't actually have to be an emerging manager to go. So I think it's much easier to meet VCs as a founder than it is to, and this is my opinion, and I'd like to go deeper on this, but in terms of just meeting the LPs and getting access to them, finding the right GPLP fit, I think that's also a challenge too. So I think that's what makes it hard. I guess the profile types,
It's one of the reasons. It's one of the reasons. But on the
yeah.
other side of that, of course, raising money in this
Hmm.
private market of GPLP is really hard and takes time, and you got to
Yeah.
kind of find the right people. But I think the flip side of that is, and I'm going to say something a little bit negative, but I believe it's true.
Hmm.
Even if we take all those emerging managers and we give them the capital that they want, right? You want to do a $30 million fund? Here's your
Yeah.
30 million. Go. The majority of them are going to lose money
Hmm.
because there's only so many good companies getting started every year out
Yeah.
there, right? And there's now a tremendous amount of competition on those deals, right? And there's still a lot of dry powder out there, even though the market is changing and,
Hmm.
of course, access to capital is becoming limited. There's only so much. And then if you're really investing in the company, what's your ability to actually guide them to success, right? So there's a
Hmm.
lot of folks that haven't really walked in the founder's shoes, that haven't gone through the ups and downs of entrepreneurship, who are deploying capital now. And in a way, I think it's kind of negative almost because, like, they don't know how to help founders, and founders would call them up and say, hey, dear VC who hasn't really gone through this journey before, what do I do when X, Y, and Z happens?
Yeah.
And they're not necessarily going to have the right set of advice for them. And I think
Hmm.
that I see that, I've invested in over 100 companies over the last 12 years. And I see that, sometimes when you take money from the wrong people who are not really, very experienced and skilled in what they're doing, it could actually be pretty bad for your business, right?
Hmm. Yeah.
Pick your investors wisely as an entrepreneur. So the
Well,
fact
I
that we
think
have,
also as VCs, I think you have to pick your LPs wisely too, right? I mean, I think there's so many similarities with just kind of the LP GP fit and then also just the founders. But I mean, I think the other piece is I think I look at it as closing capital and then essentially fulfillment, right? Like as a VC, you're fulfilling on the capital. You got to find really great deals to hopefully return the fund or at least return the benchmark that's expected. And I think that's a lot of pressure too, to make sure that you're performing.
It is a lot of pressure, especially
Mm-hmm.
in a very competitive environment.
Yeah.
You probably early on in your VC career, when you're creating a new fund, you'll be working day and night for years and
Mm-hmm.
years and years to come.
Yeah.
And you've got to both raise and you got to compete for the best deals. And
Mm-hmm.
again, as I mentioned, there's only so many of them out there. There's only X, good deals that happen every year, and you got to be in one of them or more.
Yeah.
And also, the way that the venture capital market is structured, there's increasingly an advantage for bigger and bigger players, right? Like, you're not gonna out compete with like Andreessen Horowitz on winning a Series A round,
Mm-hmm.
unless you have, I don't know, it's going to be really hard, and you're not going to be able to create better services to companies than they're doing because they have unlimited budget and they've hundreds of
Yeah.
people just focused on that. So how do you really compete? You got to really find your niche, find your focus, find your differentiation, and be able to demonstrate that it actually makes an impact in the market, and you can get into those, some of those best deals. And
Mm-hmm.
a lot of folks out there raising money, they're not really in a position to do that. So I think, generally, I'm pretty pessimistic about what's going to happen to startups and VCs over the next year or two. I think we're going to see a lot of folks just, sort of exit the category or close down their companies because,
Mm-hmm.
we're no longer in a bubble, and funding is going to be much more complicated, and only
Yeah.
the strong and fit are actually going to be able to survive.
Mm-hmm. Some of the insights I got, just talking to a couple LPs, and I've posted all of these publicly, but I thought they're pretty helpful. So, the feedback I got, and would love your insights, especially being on the other coast. But, essentially a lot of the funding and capital allocation happened like the first part of last year, and then some of it kind of slowed down. And then with all that happened recently, what the feedback I got was there was not still not a lot of capital calls. So in that sense, in the beginning, you kind of think that's negative, but it is also nice to hear because that means people aren't panicking, like trying to call all their capital immediately, and people are kind of holding off a little bit to try to find the right deals. And there's a little bit of activity. I think some people have said there could be some IPOs this year, but I want to hear your opinion in terms of just kind of what the emerging managers should expect. I'm actually going to a little emerging manager meetup in a couple hours, so I'll be, I'm going to hear a lot of inputs from them too. But just kind of, how do you think 2023 is going to play out? In the next 6-7 months, taking us to the end of the year.
I think we're in a different environment, and it's not necessarily a really bad or unhealthy one. It's actually what happened before in 2021 and 2022, which honestly, I consider that to being a bubble. And
Yeah.
if you're a fund manager and you raised $1 billion, because the foundation was, I do Series A rounds, but Series A rounds are done at $100 million post, right? And that's why I need to hit my ownership target of whatever 20%. So I need to invest $20 million in that round, and that's why I need 50 companies equals $1 billion, right?
Yeah.
Now you're looking at a very different landscape.
Yeah.
Where
people were raising for like the 2021 kind of ecosystem, and they're kind of stuck in that vintage now, right?
So that goes back to capital calls. I think
Yeah.
it's not unlikely that we're going to see a bunch of GPs, a bunch of managers go back to their LPs and say, you know what, we should actually downsize this through mutual agreement, because
that has happened. So like many of the funds have taken it. They've trimmed their haircut. There's one fund, I don't know if you saw Vive Capital, but they the GP was like also operating a company, and he trimmed down his AUM from I think 75.
Peter Thiel cut his AUM by half. Look at that. And the order came directly from Peter Thiel, according to the news. So that's, and I think those guys are actually at the forefront of it. You're going to see other VCs follow. And think about it this way, just like theoretically, if startups cut 20, 30, 50% of their workforce, shouldn't VCs do the same?
Yeah.
So I think, that's kind of the period we're going to go through here. And I think it's natural. It's part of the cycle. And we should just all really adjust. And it's healthy. It's healthy. Because guess what? Out of this, potential tech recession, I think we are in a tech recession, we're going to see the next amazing set of companies come to life, and it's going to be hopefully like 2009 to 2011, best 50 years in
It's the
venture.
best price point to get in, because you don't want to invest when everything's like like a 50 million pre, getting in at the highest price point. So I think kind of coming in, and kind of readjusting, being lean, pretty much as a VC, the same way that your founders are. That's a good signal to your founders too, that you're kind of really rethinking things as well. So besides the AUM drop, which I've been seeing, what other things do you think you'll see with some of the emerging managers?
I mean, I think we're going to see a bunch of pay-to-play provisions. So as an emerging manager myself, I am kind of staying on the safe side of things, keeping more cash sort of available to be able to continue to fund my companies, because I don't want to be in a situation where I'm kind of forced out in a pay-to-play recap when it comes to good companies, right? That other people could be, trying to take advantage of the situation to get, bigger ownership stakes. So that is part of that. Definitely for emerging managers who are starting, their first fund or their next fund now, just realize what you're going to go into. Like, the private markets have dried out significantly, and it's much harder to raise capital, and it's a flight to quality, right? So whoever has the track record, they have the experience, and they can convince LPs that they can really, shine through recession likely. Those are the ones that are kind of come out stronger on the other side. If you're an emerging manager that doesn't have some of those proof points, it might have been easy for you to raise in 2021, 2022, but now it's a very different environment. The flip side of that is, like we keep mentioning, if you have the capital, right? If you have a fund up and running, I think some of the best investment opportunities are going to present themselves in the next, year or two or three. And we also have new disruptive ways, such as AI. So that's why, maybe a good way to kind of summarize things on my end, that's why I'm really excited about what I do, because I focus on AI investments at the pre-seed stage. And pre-seed is anti-cyclical. The companies I invest in now are going to be big 5 to 10 years from now when the next bubble comes around. And AI is the next disruptive platform. So I can't think about a better place to be in than making pre-seed bets on AI companies today.
I'm not really a pre-seed person. I'm more like, seed plus. And so it's very valuable to get a couple inputs from you. And I know we're at time, but just maybe one or two bullets on just how to be a good pre-seed investor. What are some things that you look at over the course of time? You built a lot of these skills, but what are some things that you can look at as you're evaluating founders at the pre-seed? Is it just access? Is it like, hey, you know what, somebody else referred me to this founder, and I know that they're vetted, or are there things that you kind of test the founders on to make sure that they're essentially a pre-seed good bet?
I think access is part of it for sure. We should acknowledge that, but I think you got to be really, really good at evaluating whether those are the right people for the task, whether they have the right track record, the right insights, and the capability to deliver. For me, over 40% of the investments I make are with repeat entrepreneurs who have proven their sort of operational expertise and are able to operate very well in the target market that they're in. So
most of them have already started a company in the past. This is their second go around. Okay, so that helps to mitigate a lot of the risk.
Execution risk. It reduces execution risk. The second thing I would say is that's really acute at the pre-seed is focusing on big markets, right? TAM. I know this is a thread that is true for every venture capital investment, and even beyond. Like, even when you invest in public companies, you want to know how big this thing can get if it's a younger public company. But it's kind of like when you're building something. And this goes back to portfolio construction. When you're building something that's addressing a huge market, maybe it's competitive, it's hard, right? There's a lot to be done. But if you're actually successful, if you can disrupt, if you can really innovate in that space, then the outcome could be massive. So for emerging managers focused on pre-seed, coupling those concepts with the right portfolio construction, because naturally a lot of companies are not going to be able to make it. But if you do, which is what I do, actually. That's what I believe in. If you make 25 to 30 bets in a fund with strong repeat entrepreneurs who have been able to do it before, in targeting big markets that are proven markets where customers will buy a product that works better, right? That really does things way
Mm-hmm.
better, makes an impact on them, on their financials, on their operational capabilities for those customers. You're going to hit one or two or three winners. And that's what I've been able to consistently demonstrate. So to
Yeah.
be a great pre-seed investor, you got to have access, you got to have a way to really vet the opportunities, and you got to have the right portfolio construction that gives you the
Yeah.
right combination of alpha and beta and kind of leads to the outcome that you and your LPs expect.
Yeah. Well, this was amazing, man. Really good advice, great storytelling, and hope we get to hang out sometime in person. When you make it out here, when you're done with all your renovations, and the dust settles.
I'll be in New York soon, and I hope to see you here in the San Francisco Bay Area soon as well. So we're just getting started, and I want to thank you so much for having me. I do need to jump, but it's been great, and hopefully we can do this again soon.
Yeah, it was a good time. Thanks a lot, and appreciate all your time and generosity. Have a good one. Catch up soon.
Thanks, Joel. We'll talk
Yeah,
soon.
bye.